This screencast is looking at Summer 16 Question 1A focused on company valuations. So again, assuming that you have already read through the question fully and have looked at the requirements, if not, please do pause this screencast now and go back and look through the case in its entirety and also pay particular attention to what we're going to look at now, Requirement A. So this focus here was the first requirement in the Summer 16 exam for 17% or 17 marks. Calculate the value of prime using a net asset valuation approach and a free cash flow approach. And you should also advise Tim on how much to offer Patrick, explaining how you reach your conclusion based on the valuation results and any other relevant factors. So one of the most important things to take away from here is the number of requirements that are within this Part A. This is one thing that the examiner has started to do in recent years, and it's also a prominent item on the examiner report for Summer 16 as well. You have essentially a number of different requirements here. You have to do a net asset valuation, which is 1, free cash flow valuation, which is 2, advise Tim on how much to offer Patrick, 3, explain your conclusion, 4, and then identify any other relevant factors. And the key point is, unless you address those 5 key points, you're not going to be working off or working towards full marks for this question. And again, once we look at the past examiner feedback from this paper at the end of this screencast, we'll see a lot of students did not actually answer any of this. They only really looked at the first bit, and that's all they looked at. And you may lose up to, I imagine, 5 to 8 marks, because there is an important component here as well. So that's the core part of the evaluation question. If we go back up, and this is another thing to look at, not the core part of this screencast, but the examiner will always typically structure the paragraphs in the case study to match certain requirements in the case. So for example here, the first one was just about the background, second one about the proposed sale. This paragraph is to do with the valuations, and subsequent paragraphs are to do with subsequent chunks of requirements as well. So the examiner does help you along in terms of trying to segment. Now it won't always be exactly segmented for everything, but it does help you. The bulk of the information will be in the relevant paragraphs, which will be typically entitled that you can track them back to the core requirements, and they typically are in sequence as well. So for the purposes of Part A, we're going to focus on this paragraph here, the proposed sale of Patrick's shareholding. Again, you will have hopefully read through the whole case, in particular get a background about how Prime is a company that operates in the gym sector, and there has been a change of ownership in recent times. So you're told here that Patrick has proposed that Tim buy his 50% shareholding, so half the company, and he would sell to Tim if the offer is in the region of 7 million. And if the shares goes ahead, or the sale goes ahead, it'll be proceed on the 1st of January 17. So Tim is seeking your assistance on a valuation, and so you're required to prepare a valuation using 2 approaches, which we know already. And Tim is considering offering 20% of the consideration subject to an earn-out agreement based on net profit target for over the next 3 years. So you won't get all the cash up front, you'll get 20% based on if the company hits certain targets over the next 3 years. So that's all the real information here you're given, and you're also told there's relevant information in Appendix 1. And so hopefully before we even look at Appendix 1, you should know if we have to do a net asset approach and we have to do a free cash flow approach, there's certain things we need. So we'll expect, if you've done prior questions, to get some information about a statement of financial position, to get all the assets and liabilities. Likewise, for a free cash flow approach, we're going to need something about a discount rate and something about projecting out future cash flows. So again, you kind of have it, and that's why it's important to read the requirements first, because if you've read the requirements, you will know what to expect when you actually start reading the question. So don't do it vice versa, always read the requirements first to again prime you as to what to expect when you're reading. So if we go to Appendix 1, we're given now information about the Statement of Comprehensive Income for Prime. So for 2016 on the left column, 2015 on the right. And we're also given a Statement of Financial Position with a number of different notes. And we can see Note 1, Note 2, and Note 3 correspond to 3 relevant pieces of information here. And again, similar to the structure as I said before about the examiner, this is really relevant for your net asset approach. And again, the examiner has segmented the other information which will be relevant for your cost of capital, which is your discount rate, and your free cash flow valuation. So this is for net asset approach, this is for your free cash flow approach. So going back to the question again, we're looking here, we're going to do, and my advice is always, particularly in valuation questions, do the easier one first. Typically the easier one will be the net asset valuation. That will be the least work involved, and it's good to build some confidence and also get some marks on the board. So let's start off with the net asset valuation. Now, there's two real approaches to going towards the net asset valuation approach. You can firstly either restate the whole statement of financial position, so starting from here and restate each of them, as is typically done in the suggested solutions. Now, this is entirely fine, but in terms of an exam setting, there's really no need to go to that much effort. You can start at the value as per SFMA and make some adjustments off that. That's typically the most efficient in terms of your time. Start from what the value is currently as per the SFMA, and then any relevant adjustments you may find from some of the notes. So the value from the SFMA, so again, take a minute now, write down what you think the value of the SFMA is. So hopefully you'll have taken this figure to be 16,919. A number of students would have taken the 25,653, but remember that is equity and liabilities. You want equity on its own, which is total assets minus total liabilities. So it's the 16,919 is 25,653 minus your current and your non-current liabilities. So make sure you do not make that mistake. Sometimes the examiner can be very tricky and not put in this subtotal at all, and a lot of students will take the incorrect figure. So once we have started with the book value as per the SFMA, we then note, is there any adjustments to be made to get to a more updated net asset value at the end of December? And we're told three pieces of information based on the accounts we have. So note 1 talks about the assets, or the property assets. They've not been revalued for a number of years, therefore the valuation is stale. And they comprise of gyms located in commercially property units. Alright. Analysis suggests they could achieve a total rent of 1.48 million if they were leased in open market, and commercial property of this grade is currently valued at a gross rental yield of 8%. So this is a roundabout way of telling us what is the updated value of the property assets. So if we come over here, the updated value, and this is typically how a lot of commercial property, like your office space and your industrial spaces, is priced. They know what the rent is, and they price it based on what yield would that incur. What yield would it earn? So how you get the value is you put the rent, which is the annual income, 1480, divided by the gross yield, 0.08. So it's telling me that that price, or the value of those property assets, is 18.5 million. So essentially you can see the relationship here. If you paid 18.5 million for it and it earned 8% a year, that means it earns 1.48 million, which is the rent. So typically a lot of the commercial property, if you look at the commercial section or property section of an Irish Times or Sunday Business Post, they'll talk about what the property is yielding, and that's what they call the rental yield. Note, this did come up before. Look at summer 2015, a very similar adjustment came up in the valuation question. So the updated value is 18,500, whereas the value in the book was 20,830,000. That means that there is a revaluation downwards adjustment needed because the market value of the property is less than its book value. So we'll call it here prop adjustment, and it's to the tune of 2.3 million. So you're going to adjust the book value, or the net asset value of the property, down by 2.3 million. As I said, if you want to look at a similar adjustment there, look at summer 15 at the valuation question there as well, which I think did come up in the case study. The second note tells us here, so very recent technological advancement in fitness equipment has rendered much of the prime's equipment obsolete. So the reason to assume that the value of plant and equipment should be reduced by 45%. So again, another write down, plant and equipment needs to be written down by 45%. So it's going to be a negative because you're going to adjust it downwards, and it's 4250 times 0.45. So you're adjusting that down by about 1.9 million. So another evaluation downwards. And the final adjustment then, you're told trade receivables include 68,000 owed to Prime by 3 private fitness instructors who paid Prime for the use of facilities. However, the Primes recently learned that they've left the country and are unlikely they're going to be paid or recovered. Therefore, this is essentially a bad debt. We valued it in the book at 185, and actually 68 of that trade receivables should be written off. So another evaluation downwards. And that's why I tell students to start with the net asset approach, because that's essentially all you need to do. You start off with a starting point, which is the value as per the SOFP. Again, just make sure you take the right figure. Then you make a number of adjustments, and in the net asset value, as per the for prime at the 31st December, is about 12.6 million. And that's all you need to do. You have about 3 or 4 marks there. So it's nice, you've got marks on the board, and you've got a bit of confidence. So we've answered one part, one requirement of the 5. The net asset value of prime is 12.6 or 12 point around 7 million. The next one we need to do now, if we go back to part A, is a free cash flow approach. Now typically in any of the exam questions you will either get a free cash flow approach or a dividend valuation model approach. These are what's called an earnings or cash flow method, where you're essentially going to discount cash flows, and they're typically fairly technical, that there will be a lot of calculations involved, hence why you're more likely to see them in any valuation question that does come up. So when doing a free cash flow approach, there's 2 things you need. You firstly need cash flow projections, and the second thing you need is then you have the cash flow projections, you need a discount rate to discount them back to their present value. So they're the 2 things you need to work on. If we go back to the information that we're given in Appendix 1, we're told about our cost of capital. So we're told about different information, which we'll come back to at the end. And we're also told different assumptions about the free cash flow valuation. So you're told Tim has done some prep work on the valuation of prime and some of the relevant information below. He suggested using the 2016 figures and adjust for the following years as follows. So one of the key things to note about when you're doing a free cash flow method is you're going to have 2 distinct periods. So let's just call them here, put one in yellow. That's what's called the forecast period. And then from there on in, you're going to have what's called the horizon period or the terminal period. We call it the horizon period. So the forecast period is typically where you have discrete cash flow forecasts. So you can actually forecast out exactly what the cash flows are going to be each year in the forecast period. Now that typically, to be realistic, is only going to be between 3 and 5 years, because anything after that, there's a lot of uncertainty. However, the point is, when you're valuing a company, you can't just assume there's only going to be 5 years of cash flows. You have to value that chunk from year 6 onwards as well. And how you do that is you take a very simplistic assumption, a long-term growth rate. So you use long-term growth rate. Instead of saying here's what the forecast is at year 8, year 9, year 10, you say I assume it's going to grow at a certain rate into infinity. And that way it's essentially like a perpetuity with growth, and you can take a shortcut formula to calculate what's called a terminal value. Okay, and you have to be very comfortable with these, because this is a very common exam topic, how to deal with a free cash flow, or the very similar logic when you're dealing with a dividend discount model. You have an explicit forecast for a number of years, and then after that you just put a line in the sand and say I can't act or forecast with any accuracy after that, so let's just take a simplistic long-term growth assumption. So in this case here, we have to figure out, well, what is the forecast period here? And you're told here the net profit and depreciation are expected to grow at 6 and 6.5% respectively over the next 3 years. So we now know the forecast period is going to be 2017, 2018 and 2019. And from 2020 onwards, we're just going to take a simplistic assumption with a growth rate. So here we're told about the other assumptions in terms of investment in non-current assets, sometimes known as capital expenditure, and working capital investment. You're told what they're going to be in 2017 and what they're going to grow at for the next 2 years, i.e. 2018, 2019. Interest costs are expected to remain flat, that's okay. And after 2019, it would be reasonable to assume that free cash flows will grow at 2.5% annually. Hence, that's what your long-term growth rate is here. It's 2.5%. So you see, they don't go to the bother of forecasting explicitly each element. They just say whatever the free cash flow is in 2019, assume every year subsequent it grows at 2.5%. So it is simplistic, but it's the most realistic in terms of what you can forecast with any degree of accuracy. And you're told you can ignore any tax implications. So that's the first part. Is we know what the forecast period is. So let's do our forecast for 2017, 2018 and 2019. So let's start off with net profit. And I'll just put in 2016. This is solely here for a baseline because we'll be using some of the figures. I'll just use a different color here just so it'll stand out. So first is net profit. So net profit in 2016, if we go back to Appendix I, was 114. And we're told in our Appendix I that net profit will grow at 6%, should I say, for the next 3 years. So very straightforward, and you may do this in a working, do it in a neat working. It's 6% per annum for the next 3 years. So 2017 will be 6% higher than 2016. I'll just put these, tidy them up. Likewise, 2018 will be 6% higher than 2017, and 2019 will be 6% higher than 2018. So nothing earth-shattering there, but it's just a matter that you actually make sure that you get every line, you make sure you read carefully what they're telling you. Depreciation, same kind of concept, except it's growing at 6.5%. So you go back up, we're told depreciation, so a lot of students took the wrong column here. Remember, you're looking at the 2016 as the base going forward. Depreciation is 1850. So we go back now, it's going to grow at 6.5%. So grow at 1.065, 2017, 1.065, 2018, and 1.065, 2019. So again, if this is going too fast at any stage, use the benefit of the screencast, go back now, pause it, and go back and recap of where I'm getting those figures. Some students may be asking now, well, why are you adding back depreciation to net profit? So remember, net profit is an accounting figure that's already taken off depreciation. We want to get to a cash flow figure. Depreciation is a non-cash expense, therefore we add it back. We'll also then take off our investment in working capital and non-current assets. Sometimes these are shown separately, other times they're accumulated together, such as here. And we're told explicitly this is 1190 in 2017 from the bullet points, and it will grow at 8% thereafter. So it will be times 1.08 in 2018 and times 1.08 for 2019. The key point being it's a negative figure because this is a cash outflow. You're going to have to increase your working capital investment either in stock or debtors, and you're also going to have to invest in new current assets for non-current assets, should I say, for capital expenditure. Now, one other important adjustment that many students would have left out here is why you're told interest costs are expected to remain flat over this period. So when you're doing free cash flows, there's two real approaches you need to do, or you can do, should I say. It's either free cash flow to the firm, so we'll call it free cash flow to the firm, or free cash flow to equity. Now, there are two different approaches, and it really depends on what information you have will dictate which one you do. So the approach is free cash flow to the firm or free cash flow to equity. The cash flows here will be cash flows pre-interest. So that means it's free cash flows to the firm. So before any interest is paid, before any dividends are paid. Here, this is cash flows after all debt payments. So these are cash flows that are just available to equity holders after all interest and capital repayments have been made. So that's where you distinguish between cash flows pre-interest is for when you're valuing for the firm, and cash flows post-interest and post-capital repayments gets you free cash flow to equity. And of course, to be consistent in the discount rate, for the firm you should use the firm discount rate, which is WACC, and for the free cash flow to equity you should use the cost of equity. So you're just comparing like for like. This is the cash flows to the firm, this is the discount rate for the firm. This is the cash flows for the equity holders, the discount rate for the equity holders. And the resulting value then, this will be enterprise value, and this will be equity value. So if you have, and we'll see here why we're going to use this approach, we're given information here about the WACC. We have to calculate the weighted average cost of capital. Therefore, we're using this approach here. We're going to calculate the free cash flows to the firm. Therefore, we need to add back interest, because if we see here, interest is taken away before we get to net profit. And because we calculated pre-interest, we're going to use the WACC, and that will get us to an enterprise value. And when we get to it, we'll have to make one small adjustment, i.e. take off debt, before we get to the value of equity. So again, that's one small little quirk. It only appears every so often, but just watch out whether you're valuing the free cash flows to the firm, in which case you're getting an enterprise value, or whether you're valuing free cash flow to equity, in which case you're getting directly to the equity value, or the value of the firm, or the value of the equity shareholding. So in this case, we add back interest, and we're told interest is flat each year of 510, and we're adding it back. Right, so they are all the adjustments we need to make for the forecast period. We add them up. So it's 1411, 1451, and 1492. So they are the cash flows, and I'll put them in yellow again to be consistent, for the forecast period. We know exactly what they are, and we can treat them very similar to an NPV calculation. Discount this 1 year, this 2 years, and this 3 years. And the last thing we need then is, well, what's the free cash flow in 2020? And that will be 2.5%, as you're told here, larger than the 2019 figure. And we'll come back to why we need that at the end. But if you're valuing a perpetuity with growth, which essentially that is what this cash flow profile will be from year 2020 onwards, we need this cash flow here, and we'll go back and we'll use that to calculate a terminal value when we get the discount rate. So that is your first step we've talked about, and we put this in green. We've now calculated what the cash flow projections are for the forecast period and for the first period in the horizon period. That's all we need there, and we can use a shortcut formula then to subsequently work that out. The next thing we need to figure out then is what discount rate to use. And you're told here, Prime has similar companies to Prime has a beta of averaging 1.3. Risk-free rate is 3%, and the market risk premium is 5.5%. You're told long-term debt is an 8.5 million interest-only loan. 6 years ago, it was taken out at an interest rate of 6%. However, the current lending rate to the company will be 7%. And it's important, that is the relevant rate here, not the historic rate. You need to use the rate that if you were borrowing cash, i.e. what's called the marginal rate, if you went out to borrow new funds today, Prime would pay 7%, therefore that's the relevant rate. So what a student had to do here was, although it wasn't directly asked in the question, you need to do a small WACC calculation. So we know we have some part of the company is funded by equity, and we will have to calculate a cost of equity. If you ever see beta mentioned, you're going to have to calculate using CAP-M. So cost of equity using CAP-M. So the capital asset pricing model says the cost of equity will be the risk-free rate, which is 3%, plus beta times the market risk premium. And that comes to about 10.15%. Now you may want to make a small adjustment to the beta because you'll argue it's a private company. That's entirely acceptable as long as you state that assumption. But around 10.15% is the cost of equity. The cost of debt, KD, well, you're told the relevant cost of debt is 0.07. So remember, you need to take the current cost that if you went to borrow funds today. The other thing you need to be aware of here is that there is a tax rate. So if you have cost of debt, or if you pay debt, it is tax deductible. Alright, so what you need to look at here is, well, what's the relevant tax rate? So it does say ignore potential tax implications here, but that's for the funding transaction, not for the actual valuation. So again, I would have misread that at the start, and you'll note here you're actually told what the tax rate is. So you can see sometimes you need to go back and look for information in the case. Am I being fed information that I may need again? The next part we need to calculate now is the cost of debt. So the cost of debt will be, remember we said we're going to take the marginal cost of debt, i.e. the cost that you would incur now if you had to raise it here. So the historic rate 6 years ago would have been 6%, but it's now 7%. And you need to take the tax rate off that, because if you look at here, you're told, sorry, I went down too far. Tax rate is 12.5%, so 1 minus 0.125. So this is coming back from your CAP1 knowledge. When you're doing weighted average cost of capital, interest on debt is tax deductible. Therefore, to get the cost of debt, you get the after-tax cost of debt. So the after-tax cost of debt then is 6.13 or 6.125%. Now note, some students may got confused here about the ignoring tax implications. That is only for the funding of the transaction analysis, not the actual valuation. It does not say to ignore tax for the valuation. So we have the two costs. Now we need the values. Well, we know what debt is. It's 8.5 million. Now there's two different figures you could take for equity. I'm going to take this figure here, the book value of equity. You could also argue, as is done in the suggested solution, you should take the updated book value, which of course is the value as per the part 1 of this question, 12.609. So either way it would be totally acceptable. Now we just weight them. So the total capital in the company is 25.4 million, and that represents about 66% is equity, and about 33% then is debt. So this is very similar to a CAP1 style WACC question, but again, it's an applied knowledge here that you weren't directly asked for the WACC, but you had to know, based on doing a free cash flow valuation, that a WACC was required. So weighting each of them, 10.5% cost of equity for 67% of the company, and 6.125% cost of debt for 33% of the capital of the company, means the overall WACC is about 9 or 8.8%. Now you may get small different variations depending on what figure you take here, but in and around 8.8% to be your WACC. And that is the figure now we're going to use to value the projected cash flows we have for the free cash flow method. So let's get the present value of each of the cash flows, and I'll just move these down. So the first 4 years of the forecast period are very straightforward. It's you take the future cash flow and you divide it by 1 plus the discount rate to the number of years. So 2017, if we're valuing at the start of 2017, we're discounting this by 1 year. Similarly here, this is 2 years time, so it's the future cash flow over 1 plus the discount rate to the power of 2. So this is like a very simple NPV calculation for the first part. And finally then 1492 divided by 1 plus the discount rate to the power of 3. So 3 years, 2 years and 1 year. So that is the present value of the first 3 years cash flows, because we have those individually and we have them forecasted out, therefore we can discount them back. What we don't have now is, you can go on and you can do 2021 will be 2.5%, 2022 will be 2.5% higher than that, all the way out. And of course, if you have Excel, it's very easy to do that until you go out to such a stage where there's very little value in the cash flows once they're discounted. But the point is, you should know from your CAP1 time value of money subject that this essentially is what's called a perpetuity with growth. And such a cash flow profile, there is a formula to get the present value of all those cash flows and a shortcut method. And the formula is, you take, I'll just put it up here, you take the free cash flow in the first year, so we'll put that in, I'll just put it in 1, over the discount rate, we'll call R minus G. So that's essentially, I'll put it here at the start, the present value equals the free cash flow in the first period, i.e. the first period of the horizon period, over R, which in this case is the 8.8%, minus the growth rate, which is 2.5%. So again, this is very important, that this is a common question, so go back and look at prior Valuations comes up every year, and a similar type question comes up nearly every year as well. So to get the present value, which will be in 2019, so if we get the, put it up here, value of what's called the terminal value. So that is what this is called. When you're calculating the value of all these future cash flows, it's called a terminal value. So the value at the end of the forecast period. And this will be the 1530 divided by the discount rate, which is the WACC, minus 0.025. So about 24 million. And note, you have to be very careful here. That is the value at the end of the forecast period. So that is always, there's always one final step, is to get the present value of the terminal value. That may be confusing, but you have to understand that this formula values it at the first period. So at the start of the first period, which is at the end of 2019, that's how this formula works. We're valuing the company at the start of 2017, so we need to discount this 24,267 back another 3 years. So it's essentially being treated the same as a year 2019 cash flow. So now it is these set of cash flows, the three distinct ones from the forecast period, and the final present value of the terminal value, giving us a total value of prime to be adding them all together. Sorry, wait. The sum to be about 22.5 million. Now you may get different variations depending on what assumptions you used for the WACC, but in and around 22 to 23 million will be the value of prime, and that's important, that is the firm. So let's move these down. So remember again, we use the free cash flow to the firm, therefore that's what's called the enterprise value. To get to the equity value, we take off debt. And the debt in this case is 8.5 million. So we're saying the equity value here, based on the free cash flow method, is around 14 million. Now again, you may get variations on assumptions used. So that is essentially the second core requirement, is the value in an asset approach is about 12.6. The value in a free cash flow is 14 million. And unfortunately, this is where a lot of students stopped. But remember, if you go back to the requirement, that was only the first part. Part 1, an asset approach. Part 2, free cash flow prime. Now we should also advise, you see the way the examiner uses bold, Tim, and how much to offer Patrick. Well, Tim is buying 50%, therefore you're going to offer somewhere, you're saying here, 50% of that is about 7 million. And you're saying 50% of that is about 6.3 million. So your range here, the range for 50% is between 6.3 and 7 million. So the examiner was looking for you, how much should Tim offer Patrick? And again, it was really a more commercial perspective here is, well, you know from the question, and again you have to read the requirements or read the question in depth. You know, Tim has indicated he would sell in the region of 7 million. And you've, based on your evaluation, you think the 50% is somewhere between 6.3 and 7. So it makes sense to you to advise Patrick to offer less than 7 million. There's no point going in with the highest range you offer, because that's a poor negotiation starting point. So the examiner was looking for you to advise, perhaps start at the lower range or even lower, perhaps offer 6 million, as long as you offer a reasonable enough starting point that you can engage in negotiation. Offering too low, for example 5 million, you may otherwise annoy the seller, and in that case you may not initiate negotiations at all and make it very difficult. So offering somewhere around the 6.2, 6.3 million may be a good starting point, and you may avoid the possibility of having to overpay or get into very difficult negotiations. So now we've answered 3 requirements: calc, and advise. How did you reach your conclusion? Well, again, all you have to say is 2 points. 1, you know Tim will take about 7 million, therefore that's a starting point. And you also know that the range is about 6.3 to 7. They are your two reasons or your two justifications. Again, there will be marks going for it. That's why it's in the requirement. Make sure you get those marks. And the final one, what are the other relevant factors? And again, as long as these are reasonable, the only students that lose out on marks here typically are the students who leave it blank. So you can look at the background of the question, and this is important. You need to step into the shoes of the people involved. What are the relevant factors here? Well, one would be Prime is a private company. You could validly argue that taking just 50% of it, you may need to take a discount on that because it's a private company, because it may be very difficult to sell a shareholding in a private company because it's not a traded company. You don't have a PLC that you can just go and sell shares at a broker. It's a lot more of an illiquid market. So it's difficult to market and sell those shareholdings. Second thing is then as well, the financing, which is a separate part of this question, will also have a big impact. Because if you take on debt, and you'll see more in the suggested solution, it can be very tax efficient, meaning you may be able to, because of the tax savings you make, you may be able to afford to pay more initially for the company. And finally then of course there's the earnout. Because you have a significant portion of the consideration, i.e. a fifth of it, will be in the form of an earnout, i.e. not cash up front, there's a bit less risk that you will overpay. Because if you just pay cash up front and then Prime went into difficulties because of the economic conditions, well then you're losing out because you've paid all the cash up front. Whereas if you have an earnout, some of that risk of poor performance falls on the vendor as well. I said there's plenty of other relevant factors, but typically the only students that lose out on marks there are the ones who unfortunately leave it blank. So that was the valuation question for 17 marks. Just having a brief look at the examiner's comments, I just wanted to draw your attention to one or two. Two fundamental points. Candidates need to read the question carefully and address each part, and the examiner in their report used the example of the question we just did. A lot of students did not provide advice on how much to offer, and a small minority incorporated other factors. Again, very disappointing given that there were several distinct parts. Alright, so you can see here the examiner used that part of the question exactly as a prime example of where students did not answer everything that was asked. So make sure to pay attention to what's asked and make sure you answer each requirement in the question. So be very observant for areas such as and or separate sentences, because the examiner will use bold to try and identify or highlight to students there are multiple requirements here. So go back and look at that Summer 16 examiner report as well. So that was Summer 16 question 1A on company valuations.